$13.61 million. That's your 2024 federal estate tax exemption, the amount your household can pass to heirs completely tax-free. Sounds untouchable, right? Wrong. New 2026 wealth concentration data shows the richest 1% now controls more wealth than the middle 60% combined. And when Congress sees that number, exemptions historically shrink. Here's the problem. If exemptions drop to $7 million, which is the pre-2025 baseline, a household with $3 million in assets today could face $200,000 to $500,000 in additional lifetime estate tax liability. That's a 47% swing in your tax exposure, triggered entirely by public policy response to inequality data. Most high-income professionals earning $200K to $500K plus think estate tax doesn't touch them because the exemption is so high. That belief just cost you a planning window. We analyzed Federal Reserve distributional financial accounts, IRS exemption legislative history from 2009 to 2021, and Congressional Research Service reports on wealth concentration. The pattern is unmistakable. Every 10-year wealth concentration report has historically preceded estate tax narrowing within 2 to 5 years. The 2026 data enters a critical policy window right now. Tax proposals are actively being shaped in Congress, which means your positioning decisions between now and late 2026 could lock in or avoid hundreds of thousands in lifetime liability. Let's break down what the data actually shows. Per the Federal Reserve Survey, the top 1% household net worth threshold sits at $11.6 million as of late 2024. The top 10% starts at $1.7 million. If you're in the $200K to $500K plus income band, your typical net worth sits between $2 million and $5 million, right in the danger zone for exemption cuts. Here's where it gets worse. Wealth inequality metrics are now feeding directly into tax policy discussions. The IRS statistics of income shows that between 2009 and 2013, when wealth concentration data spiked, exemptions were debated and ultimately set to drop from $5.25 million to $3.5 million in 2026, a cut Congress extended then partially reversed. Same pattern again, 2017 to 2021 wealth reports, then the 2025 Tax Cuts and Jobs Act exemptions surged to $13.61 million. But that surge expires in 2026. The data cycle is real, and this time the inequality story is louder. Now the three estate structures that historically hold up when exemptions shrink. First, irrevocable life insurance trusts ILIT. An ILIT removes the death benefit from your taxable estate entirely, meaning a $2 million policy passes tax-free regardless of exemption levels. Second, dynasty trusts if your state allows them. These lock in current exemptions for multiple generations even if exemptions drop. Third, and this is the one most CPAs overlook, spousal lifetime access trusts or SLAT. A SLAT lets one spouse gift to an irrevocable trust benefiting the other spouse, using up exemption space now while keeping access to those funds through the beneficiary spouse. If exemptions drop, that locked-in gift is protected. The oversight, many advisors set up SLAT reactively after data moves, proactively before 2026 closes. You have a window to fund these structures and guarantee exemption protection regardless of what Congress does. Here's your action timeline. Between now and October 2026, request a meeting with an estate attorney, not your CPA, an attorney specializing in trusts. Bring your net worth statement and current estate plan. Ask 3 questions. First, how much of my estate would face federal tax if exemptions drop to $7 million tomorrow? Second, which of my current assets are located inefficiently for estate tax purposes? And third, which irrevocable structure makes sense for my income, family situation, and state of residence? Don't wait for the policy news to break in the headlines. By then, exemptions have already dropped and you've lost the planning window. The stakes are simple. Ignoring this trend locks you into suboptimal asset location or trust structure. If exemptions decline before 2027 legislative windows close, that cost you $25,000 to $150,000 plus in unnecessary estate taxes. But if you restructure now, before policy response, you hedge the risk and lock in protection. Numbers do not lie, listen to them.